The market feels quiet, not calm, quiet. Bitcoin is hovering in the high 60,000s, unable to break out. Ethereum is struggling near 2,000. Most of the top crypto tokens are red. Gold, which recently surged toward $5,000 an ounce, has pulled back. Silver is easing off its highs. Artificial intelligence stocks are wobbling. Big tech is under scrutiny for massive capital expenditures. Memory chip shortages are back in discussion. China is accelerating its artificial intelligence capabilities faster than many expected. And yet, nothing is crashing. Nothing is exploding. Everything is pausing at the same time. That is not random. When crypto stalls, gold stalls, artificial intelligence stalls, and equities hesitate together, that's not noise. That's compression. And compression in markets usually means capital is repositioning. Right now, liquidity is thin. China is closed for Lunar New Year. US markets are observing President's Day. Low-volume environments exaggerate moves. Traders reduce exposure. Funds rebalance. Short-term players take profit. But the bigger question is not what moved today. The bigger question is why everything moved less than expected. Bitcoin's pullback from recent highs isn't panic. It's consolidation. ETF inflows have cooled from earlier momentum. Speculative enthusiasm has softened. But the digital scarcity narrative hasn't disappeared. In fact, something interesting is happening. As artificial intelligence expands, creating abundance everywhere, content, code, design, analysis, more people are quietly reframing Bitcoin as the opposite of that. Artificial intelligence creates infinite supply. Bitcoin remains capped, fixed, algorithmically scarce. That contrast is subtle, but powerful. Now look at gold. Gold pulling back from $5,000 does not signal collapse. Central banks continue accumulating. But a strengthening dollar and reduced physical demand during holiday periods soften short-term price. Gold and Bitcoin moving together in hesitation is not typical risk-on behavior. It is not classic risk-off either. It is uncertainty. Then there is artificial intelligence. China is rapidly climbing the AI value chain. Semiconductor demand remains intense. Data center expansion is accelerating. Big tech companies are committing enormous capital expenditures to infrastructure. Some analysts call it the next industrial revolution. Others quietly whisper about overextension. Too much spending. Too fast. Returns uncertain. Markets don't fear innovation. Markets fear miscalculation. If AI infrastructure investment overshoots demand, volatility follows. If it undershoots, competitive imbalance grows. Either way, capital shifts. Now zoom out further. Recent economic data paints a mixed picture. Payrolls appear strong, but revisions soften prior strength. Inflation prints slightly cooler. Retail sales show cracks. Rate cut speculation remains cautious. The Federal Reserve is not clearly pivoting, but it is not tightening aggressively either. The system is not overheating, but it is not comfortable. And when the system is uncomfortable, money hesitates. That hesitation shows up across asset classes. Crypto compresses. Gold consolidates. Equities drift. Artificial intelligence trades sideways. Everything waits. And when everything waits together, something is forming. Markets rarely move explosively without warning. They compress first, like pressure beneath tectonic plates. Energy builds quietly, then releases suddenly. Right now, The dominant narrative is not fear, it is recalculation. Investors are asking, will rate cuts arrive later this year? Will stablecoin regulation accelerate institutional crypto adoption? Will China's artificial intelligence acceleration pressure US policy? Will capital rotate from speculative AI plays into harder assets? Will digital scarcity narratives strengthen if liquidity expands? These are not daily trading questions. These are regime questions. And regime shifts begin subtly. They begin when correlations change, when assets that normally diverge begin to move together, when conviction fades across multiple sectors at once. Today is not dramatic. That is precisely why it matters. Explosions are easy to interpret. Pauses require attention. When the market holds its breath, it is not sleeping. It is deciding. And capital does not decide emotionally. It decides strategically. Crypto is not collapsing. Gold is not breaking down. Artificial intelligence is not imploding. The economy is not unraveling. But none of them are charging forward either. That synchronized hesitation is a signal, not of doom, not of euphoria, but of transition. The quiet shift is rarely loud. It is a rotation beneath the surface. And when the next move arrives, it will feel sudden. But it will not have started suddenly. It will have started here, in the pause, in the compression, in the moment when everything seems still. This is the quiet shift.